Okay, let's talk about Northrop Grumman. This company is an absolute titan in the defense industry, with what you might call an unbreakable competitive advantage. But the real question is this fortress of a company also a fortress for your portfolio? Let's dig in and find out. First, just look at this number. $95.7 billion. That's Northrop Grumman's current order backlog. Think about that. It's like a giant wall of guaranteed revenue that's already locked in for more than 2 years. We're not talking about hoping people buy stuff. We're talking about non-negotiable government contracts. Now that is stability on a massive scale. So with that kind of backlog, it's a guaranteed great investment, right? Well, not so fast. You see, a fantastic company isn't always a fantastic stock. And the difference between the two, it almost always comes down to one thing: price. So to understand this, let's first look at what makes Northrop Grumman so incredibly dominant. The company has what investors call an economic moat, and Northrop's is just incredibly wide and deep. It's built on 4 pillars that make its fortress pretty much unbreakable. Okay, first up, high switching costs. I mean, once the US government builds a Northrop system into, say, a nuclear submarine or a stealth bomber, switching to a competitor would cost billions and take years. It's just not going to happen. Second, you've got scale. Very, very few companies on Earth can build intercontinental missiles and deep space rockets at the same time. Third, regulatory barriers. You don't just wake up one day and decide to build top-secret military tech. It requires security clearances that can take a generation to get. And finally, they have a literal treasure trove of secret technology and patents that's nearly impossible for anyone else to replicate. And listen, this isn't just theory. Look at their recent wins. A 31st successful Minotaur rocket launch, building Hungary's very first communications satellite, and providing a whopping 75% of the liftoff thrust for NASA's Artemis 2 mission. You see, these aren't just cool milestones. They are proof that this company plays a role that's almost impossible to replace. But, a fortress is only as strong as its leader. So let's pull back the curtain and look at Northrop Grumman's leadership and its financial health, which, frankly, are just as impressive as its business moat. The CEO, Kathy Warden, isn't just chasing growth for the sake of getting bigger. Her focus, and you can see it in this quote, is on disciplined execution and margin expansion. That tells you the strategy here is all about long-term stability and profitability, not just short-term wins. And that discipline, well, it really pays off for shareholders. What's this number? 21? That's 21 consecutive years that Northrop Grumman has increased its dividend. That is a powerful, powerful signal of financial health and a clear commitment to its owners. So what's the engine driving those dividends? How about a 26% increase in free cash flow just last year? That is hard cash, generated from super efficient operations, and it gives them all the flexibility they need to invest, pay down debt, and of course, reward shareholders. Now here's a number that should really make you sit up: a return on equity of over 26%. For a heavy-duty, capital-intensive industry like defense, this is just exceptionally high. It means for every single dollar of shareholder money invested in the business, the management is generating over 26 cents in profit. That is absolutely world-class. So, a phenomenal company, an unbreakable moat, great leadership, amazing financials, case closed, right? It's a must-buy. Not so fast. We've come to the most important question for any investor. What is the company actually worth? And this is where our story takes a really sharp turn. This slide lays out the problem in the starkest terms possible. On the left, you've got a calculated intrinsic value, what the business is fundamentally worth based on its future earnings. On the right, you've got what it costs to buy one share on the market today. That is a massive, massive gap. Now, that $443 valuation, it's not just some random guess. It comes from a discounted cash flow model, which is a pretty standard, conservative way of figuring out what all of a company's future cash is worth in today's dollars. So here's the crucial takeaway. At the current market price, you're paying a 36% premium over what the analysis says the company is actually worth. It seems the market is so in love with Northrop's stability that it has already priced in years and years of future success. For an investor, that means there is simply no margin of safety. But hey, what if that valuation model is wrong? It's possible. So let's get a second opinion, this time from the market itself. We can use something called Elliott wave analysis to decode the market's psychology right from the stock's chart. What we're looking at here on the chart is a classic 5-wave pattern moving up. Think of it like a story told in 5 chapters. This powerful multi-year climb fits that predictable structure, which very often signals that a major upward trend is getting kind of tired and might be nearing its end. Now, here's the really interesting part, the key warning sign. You see, while the stock price pushed up to a brand new peak in that fifth wave, the momentum indicator, the RSI, failed to do the same. This is what technical analysts call a bearish divergence. It's like a car's engine sputtering even as it's hitting its top speed. It's a classic signal that the buying pressure is fading out. So what usually happens after a big five-wave run-up? Well, typically, you get a three-wave correction, which we've labeled A, B, C here. This analysis is projecting a pullback, potentially down toward that $580 to $600 range. So what's fascinating is that both the fundamental value and the technical chart are telling the exact same story. A better price might just be on the horizon. All right, let's put it all together. We have a world-class company with an unbreachable moat, fantastic leadership, and stellar financials. But we also have an overvalued stock that's showing technical signs of exhaustion. So what's the final verdict here?
You know, this quote from the source material really says it all. This isn't some fast-moving tech stock. Northrop is a bedrock industrial giant that operates on timelines measured in decades. For an investor who shares that long-term view, patience isn't just a virtue, it's the entire strategy. The goal isn't just to buy a great company, it's to buy a great company at a fair price.
Look, Northrop Grumman's dominance is secure for decades to come. So if you have the chance to buy into this amazing fortress at a 15, 20, or maybe even a 30% discount, just by waiting for the market to cool off, in an industry that plans in decades, what's a few months of waiting?